moving a stock's price or moving the stock's return, right? So companies put out tons of information. Some of it is expected and some of it is not. But when you look at how stock prices move, right, you can clearly see that it's the unexpected information that is driving returns, right? And a clear example of this is with CEO turnover, when a CEO retires, right? So if a CEO is going to, if a CEO retires, and it's a mutual decision, right? So the CEO is not being fired, right? Or they're whatever, spending more time with their family or whatever they say. There's actually going to be just kind of a retirement. What they typically will say is, you know, if the CEO will leave in 6 to 9 months. So they put a press release out saying the CEO is going to leave. And if this has been a moderately successful CEO, the CEO, he or she will take a victory lap, you know, for 6 to 9 months, collect all the parting gifts, and then leave, right? And at the day that the CEO leaves, the company will put out another press release that kind of, you know, Elvis has left the building sort of thing, right? Now, if you look at the stock reaction to both of those releases, the release that the CEO is going to leave and the CEO has left, the only one that moves the market is the CEO is going to leave, right? Because that's the information that the market is taking on. Even that, though, is somewhat muted depending on the age of the CEO, right? Because the market already is building some expectation of turnover anyways. If you have a CEO that's 67 years old, you know, and typically the firm turns them over, well, the fact of leaving may not be a huge surprise, right? And so the market may not move very much, but let's say you had a CEO who was 52 or something like that, and they didn't expect they were going to leave, the market may react. Now, I'm not saying which way the market reacts. Could be good or bad, depending on how the market views the CEO, right? But the key is the market will move, the stock will move when the first announcement comes out that they're going to leave. When the victory lap is done and the press release comes out, there's no new information in that, right? And so the market does not move. So it's this surprise piece that really is what moves everything. I think as I may have talked about here or not, you know, you really see this when CEOs die unexpectedly, right? And so when there's plane crashes or something like that, that's when you get a true assessment of how the market feels about a CEO, right? Because if the CEO is a good CEO, you'll see the market drop. If the CEO is a bad CEO, right, and nature has done what the shareholders could not do by getting rid of the CEO, you see the market go up. And you actually, it's really true, and you see a lot of this with founder CEOs, and actually really second generation founder CEOs, because the evidence shows that founders are actually not too bad. They hold on too long sometimes because they don't know. But if the kids get the company, they just run it into the ground, right? Because it's just not a good deal, at least historically, yeah. So, if they die, that's really good for shareholders typically, right? So, unless it gets passed on to the third generation, I don't know. But anyways, the key here is it's really that surprise piece that is moving asset prices, and that comes from that, right? Now, yeah, go ahead.
Also, analyst expectations.
What about yeah?
You don't hit your consensus. You're above a month.
It can be. So earnings surprises is something that we look at, right? So if your earnings are above or below what analysts are expecting, we typically see the stock react. Some of that's become more muted because companies guide so much of that. We've seen a lot fewer surprises now because there's so much work with the company providing guidance to the analysts and they kind of walk them down. So it's getting a little bit more muted. But historically, if you do miss earnings, that's not good, right? And that's what creates this kind of short-termism for managers. They're really worried about next quarter's numbers versus worrying about the long term. And the problem becomes if I want to invest in a long-term project like R&D, which may cost me in the short term, right? I may say I might forego that because I want to keep my earnings number. There was a survey done, and I think it was, about 75% of CFOs said they'd be willing to cut a long-term positive NPV project to meet short-term earnings, right? And that's just not the right thing. That's just shareholders, you don't want that. But typically bonuses are based on, maybe hitting short-term targets or something like that, so the incentives are misaligned. Yeah, missing earnings. So we can then break up, we think about surprises mattering, and this comes back to kind of the beginning of our discussion today. We can categorize the surprises, the information content, into two broad categories, either being systematic or unsystematic, right? And as we talked about earlier, The systematic risks or systematic factors, that's going to be information that impacts a large number of assets at the same time, right? So we call this also a non-diversifiable risk or market risk, right? And so this is the big macroeconomic stuff we talked about before, things like Greece's situation or the Chinese situation or GDP or inflation or interest rates or employment. Again, these are big, this is information that's moving things at the same time in the same direction, right? And that's the key. And there's nowhere to hide. Because it's macroeconomic, you know, it's very difficult to hedge these type of risks or this type of information, right? On the other side, we have unsystematic factors, right? So these are risk factors that affect a limited number of assets, right? We sometimes call this asset-specific risk, firm-specific risk, idiosyncratic risk, right? It's just that this information is related to a firm or a very small set of firms, right? And so these could be things, again, labor strikes, part shortages, the death of a CEO, something like that would be like an idiosyncratic risk factor, idiosyncratic information, right? The key is when this information comes out, it's a limited number of assets that are moving, right? And so that's not going to impact the entire market or your entire portfolio. So we decompose our actual realized return. What we saw before, there's an expected piece and an unexpected piece. This unexpected piece can be broken into a systematic portion and an unsystematic portion. So this is not a literal equation of how it breaks down, but it's just representative. That your realized return then includes the piece that you expected, but then it has any of the systematic surprises and the unsystematic surprises built in as well, right? And the reason this all matters, the reason that we want to think about this in this way, is the returns that we demand, right, are a function of the risks that we face, and not all risks are created equal, right? Not all risks pose the same type of problem to us. And the key is because with risks such as with our idiosyncratic risks or our unsystematic risks, we can actually do something about those, right? We can limit our exposure to firm-specific risk by holding a diversified portfolio. As we already showed as a kind of contrived example earlier with Coors and Google, right? By mixing our money up, we weren't exposed to the swings because we diversified the way we held our assets, right? And so that matters that we have to identify which risks are idiosyncratic, which means we can diversify away, and which ones are more systematic, such as the Greece and Chinese issues, where everything's moving, as Clayton said. As soon as Greece voted, last Sunday they voted, was it last Sunday? And then when the markets opened on Monday, as soon as the markets opened on Monday, it popped and went down, right? And everything was basically moving down. There was nothing much you could do about that. There was nowhere for you to run. So it's important then, I guess, to think about, again, the effects of diversification. I want to show you an example of that in just a minute. But, again, the definition of diversification is investment in different asset classes. It's not just holding a lot of assets, and that's key, right? The key to diversification is that the correlation between your assets is not high. What you want is them moving in different directions at different times, right? So if you split your money up across 50 banking stocks, so you don't have all your money in one company, but they're all financial service companies or banking stocks, well, 2008, that wasn't providing you a whole lot of diversification. Not that anything was providing a whole lot of diversification in 2008, but especially holding 50 banking stocks did not mean you were diversified, right? But if you split your money, if you own 50 stocks that span 20 different industries, that's going to provide you some hedge, right? That'll provide you less correlation between your holdings, and so you won't be exposed to all those risks. I like this study here. It's a classic study, back from, I guess originally in 87, but it's been replicated a number of times. I guess 77 has been replicated a number of times since then, right? And so what this experiment was showing is the true impact of diversification, right? The fact that this is really the one free lunch that we have out there in finance. And so what these authors of this study wanted to look at was, what is the risk of you holding different type of portfolios, assuming you have absolutely no skill, right? So you know absolutely nothing about investing, you're not informed in any single way. The only thing you can do is split your money up kind of randomly, right? That's all you can do is, so this isn't about knowing more than the market, it's just diversifying. What does that get you, right? And so what they did is they took all of the stocks on the New York Stock Exchange, right? And they started forming different portfolios and looked at the risk, okay? And so first they said, well, let's assume we put all our eggs in one basket. And so they just kept, randomly picking one stock out of the whole set randomly over and over and over again. And what they saw was, if you just kind of pick a random stock in the New York Stock Exchange, then the standard deviation of your annual returns is about 50%. Really, really high. I mean, that basically means you have absolutely no idea what's going to happen. Anything could happen, right? It's extremely high. They said, okay, fine, let's set that as the baseline. And now they said, let's pick 2 stocks at random and split your money. Right? So we're going to put, imagine you have all the names of the New York Stock Exchange stocks up on a wall. You have 2 darts. You throw 1 dart and you throw a second dart. Whatever they hit, that's where your money's going. Right? And you're just going to split equally between those 2 stocks. Right? And again, they do that kind of over and over and over and over again. And what they find is the standard deviation of that portfolio, where the money's randomly split between 2 stocks, falls to 37%. It's still high, right? But relative to where we started, that's a 24% decrease for doing nothing. Right? You had no idea. You just randomly picked 2 stocks out of a hat, and you reduced your risk by 24%. Now, the key that makes this really cool is that these darts that they're throwing are magic darts. And what makes them magic darts is it controls the expected return. So the thing here is they're not giving up any return in what they're picking, they're just lowering their risk. So you're not having to actually, because it's not too much of a magic trick if you just lower the return and lower the risk, but the fact that you're holding return steady and lowering your risk is pretty cool, right? And they continue this process. Now, instead of throwing 2 darts, they're throwing 4 darts. And the standard deviation has fallen down to 30%, which is a 40% reduction, right? And so they just keep increasing the number of darts that they throw, 6, 8, 10, 20, right? 30. And when they get around 30 darts, the standard deviation of the portfolio. So now again, you have 30 different stocks, evenly split your money across them, right? Your average standard deviation on your annualized return is now 20%. It's dropped over half. You haven't given up any return. You know absolutely nothing because this is just random, and you eliminated more than half of your risk, right? So this sounds like a pretty good deal. So there are like, thousands of stocks in the New York Stock Exchange, so why stop there, right? You just keep throwing darts. But what you can see here is there are diminishing returns. So even if we get up to 1,000 stocks, right, we've only now fallen to 19%. So from 30 down to 19, there's very little impact in reducing risk. It's really on this front end where we go from holding a couple stocks to kind of a more broader 20, 30 stocks that you really see the impact, right? But still, notwithstanding, it's a pretty dramatic decline. And you can see it here in this picture as well. So this picture is just a representation of that table, where in the x-axis we have the number of stocks in the portfolio, and the y-axis you have your annualized standard deviation. So one stock is getting 50% standard deviation, around 20, 30, you get down to 20. And then what this really illustrates here is it's not just any risk that gets eliminated, right? It's that idiosyncratic, unsystematic risk that goes away. All of that firm-specific risk that you face if you hold the stock, right? If I put all of my money in Google, I am subject to anything that happens to Google, right? They make the greatest discovery in the world, great, I make money from that, right? They have a huge accounting fraud and go under, I'm exposed to all of that, right? So I have to take all of that. If I hold Google in a well-diversified portfolio, none of that's really going to matter, all right? Something great happened to Google today, well, something bad happened to another one of my companies. Something bad happened to Google, something great happened to another one of my companies, right? As long as it's idiosyncratic to that firm, right? So I'm able, by mixing these things up, to basically eliminate, maybe a little bit, but pretty much eliminate all of that firm-specific risk. That being said, that systematic chunk, that non-diversifiable risk, that Greece risk, that China risk, that employment risk, all of that, there's not much I can do about that, right? Because when bad news hits, right, if Greece implodes, everything is going down at the same time, right? There's nothing providing a hedge for that.
Like the financial crisis.
Right, like the financial crisis, right? Extremely, there's nowhere to go, right? And the more correlated the assets are, right, the less there's the little protection that you have. So this big blue box represents your non-diversifiable risk. So what we can take away from this is once you get to about 20 or 30 stocks in your portfolio, basically all you're left with is market risk. You've eliminated all the other kind of firm-specific risk, right? Which is pretty cool.
Where does the 19.2 come from? How do you?
That was kind of the minimum. That was kind of the minimum here for 100,000 stocks. Yeah, that's all that represents. That's if you kind of went out to the extreme here of holding everything truly the market, if you call that the market, that's kind of the minimum. But the key really is after about 20 or 30, it doesn't buy you very much. Right?
And that's the big complication. All this thought, you put one thing, you do all this great stuff. It's just an observation, it's not an observation, opinion. You could probably be just as well be an index as overall. I mean, you know,
Yeah, I mean,
because this is kind of like saying.
In the long term, index funds outperform all mutual funds.
What's that?
In the long run, index funds outperform mutual funds.
well, yeah, and the key is because of the fees that are charged by the active funds, right? So if you go buy Vanguard fund and they charge you 10 basis points, or let's say 20 basis points, or whatever, so 0.2%, right? And, or you go to an active fund that's charging you 1% or 1.5% or something like that,
In the long.
that's a huge difference, right? Because that just sets up a hurdle for that active manager that they have to outperform the market by more than 1% to justify the fee. And that's hard to do year after year after year, right? So the evidence is, if you look at the distribution any year, there are always going to be managers that beat the market. Just that's the way it is. It beats the average, right? The key is you have ones that reliably beat the market.
You pick the second one.
Yeah, well, whatever it is, you can pick one, right? So, but then the question is, does it reliably do that? And the evidence, all the evidence I see has there's little evidence that the people repeat, that the top performers repeat over the long term, right?
So it said in the footnote on the slide right beforehand that it's based on information from '77, but I know that like Benjamin Graham was saying pretty much the same thing back in the '40s.
Yeah, this was just, the study was first done in the 70s. This
Right.
formalized study.
But
was done.
the idea of diversification.
Oh, yeah. Moskowitz, he won a Nobel Prize in the
Right.
50s from, so this is not from 77, but this is when the data got a lot better, and we could measure it more precisely, yeah, and this has been done over and over again, yeah, absolutely, yeah. But yeah, the observation, Mike, is absolutely right, that, that you can achieve this type of portfolio very cheaply with an index fund. And an active manager then kind of has that as a hurdle to get past that. And I think it's that's the question, is there actually skill or not? So then what we want to be able to do here is come up with a measure. So now that we see that there's a difference between systematic and unsystematic risk, that I can do something about, I can diversify away the unsystematic risk, right? But I'm kind of stuck with systematic risk. I'd like to be able to measure these different types of risk when thinking about the risk-return trade-off. Well, let's first start with where we have been. Up till now, we've been using standard deviation of the returns as our measure of risk. And that's a fine measure. It's just we have to recognize it measures total risk. So when you calculate the standard deviation of Google, right, you say it's 17.4%, that represents the total risk of investing in Google, both systematic and unsystematic. Okay? So that's not capturing exactly what we want. But for a well-diversified portfolio, so if you hold the market or you hold a basket of like 20 to 30 stocks, the unsystematic piece is very small, right? And so the total risk for a diversified portfolio is close to a measure for systematic risk, right? But for an individual stock, standard deviation is not going to give us what we want, all right? So we still need something better, and we'll get there first. But before we do, let's kind of formally state the systematic risk principle, which kind of ties us all back together in terms of the risk-return framework, right? So the first thing that we know, we've seen, and we've talked about, is there's a reward for bearing risk, right? It's important for society for us for people to take the risk to invest in projects, right? That's the only way this works. We all work, we take in more money, we invest it finds the ideas, and creates productivity and goods and services and so forth. That being said, there's no reward for bearing risk unnecessarily, right? So if you think about it, right, let's assume we as society, we have 3 projects that we need to fund, right? And each project requires $100 to do what it needs to do, right? And let's see that Mario has $100, Sean has $100, and Robin has $100, right? They could each give that money to one of the companies, right? Individually. They could each individually fund one of the companies, right? And then those companies would have what they needed. But each of you would then be taking a significant amount of idiosyncratic risk, right? Alternatively, you 3 could pool your money together, right? And each put a little bit in each of the companies. diversify yourself across. In that scenario, the companies are being funded fully as well, right? So society draws no further benefit from you putting all of your eggs in one basket versus you pooling your resources and then funding the companies. So because society's no better off, you get nothing for putting all of your eggs in one basket. You can do it, right? Mark Cuban advocates it, right? But that's a whole different story. But anyways, so just get lucky and sell out right before the dot-com bubble pops, and then you're a millionaire, and then you're a genius. But anyways, but society gets nothing else from that, so you get nothing else from that, right? So there's no reward for bearing risk unnecessarily. So what that means is the expected return of any asset, and this is what, again, this is kind of the bargain that gets paid, right? The fact that society needs your money, then society, representing the market, delivers some return to you as the expected return. So the expected return of any asset depends only on that asset's systematic risk, because all of the unsystematic risk can be diversified, right? There is no need for anyone to hold that. And as Mike just pointed out, we all have the option now in this day and age, right, to go down and buy an index fund for almost nothing. The cost is very, very low. And if you're part of like a 401k as a larger corporation, they have the bargaining power where it's like down to like 10 basis points or 9 basis points or something that they charge you to hold an index fund. It is very, very low to hold a well-diversified portfolio. So there's no excuse to say that I must take on all that unsystematic risk. Now, if you think you're more informed, you think you know what's going to happen to the company, well, you can make a bet, right? You can tilt your portfolio towards one sector or one company, and you can see how things turn out. But in expectation, you shouldn't expect to earn anything more, right? You're increasing the risk without any additional return. So that's the key to the systematic risk principle. The only risk that matters in the setting that we're talking about, right? And again, stepping all the way back to the beginning here, when I'm thinking about required return of equity holders in the market, right? The only risk that they're thinking about is this systematic risk under this principle. Right? That's what matters. So we really need to find a way to quantify this systematic risk, right? And this is just a picture depicting the systematic risk principle, which just says here's your expected return, here's the level of risk, and what we see is as risk goes up, and specifically systematic risk goes up, your risk goes up as well, your return goes up as well. And what we talked about in chapter 10, and we'll come back to this in just a moment, so we'll present it here, what we're really going to focus on is this notion of a risk premium, which is the return you earn above and beyond the risk-free rate. Everyone gets the risk-free rate. We all get that no matter how much. If you want a higher return above and beyond that, you take on more systematic risk, right? And that's where that risk premium kicks in. Okay, as I said, so the key here is measuring systematic risk. Standard deviation doesn't do it. It measures total risk. All right, so we need something else. Okay? So how are we going to measure this? Well, we're going to start with the recognition, as we just talked about a minute ago, that a well-diversified portfolio, right, only moves in response to systematic risks or systematic information, right? So again, if you hold this 20, 30, 40 stocks in a portfolio, the only time that portfolio is going to move is when some type of information that moves everything comes out at the same time, right? Again, if you're holding 30 to 40 stocks and something happens just to Google, some idiosyncratic event, your portfolio is not going to move very much, right? If something happens to one stock, it doesn't move very much. It's when these systematic effects like Greece are trying to happen that moves the portfolio, right? And so recognizing that, if we were able to identify some observable, well-diversified portfolio, we could watch its movements, we would be able to watch how systematic information enters. Right? There will be some kind of something we could track that shows systematic information. Well, the market is a well-diversified portfolio. It's everything. Right? So we saw it for you, 1,000 stocks, 2,000, 5,000, 8,000, whatever, however many stocks we have. Right? The market as a whole represents a well-diversified portfolio. So if we watch the movements of the market, what we're actually seeing is the inflow of systematic information. Right? We're watching how systematic information flows into the market. So that if I want to see how systematic information impacts any specific asset, what I'm going to do is look at how that asset co-moves with the market. Right? So when the market goes up, does the asset go up? When the market goes down, does the asset go down? Right? And kind of what's the magnitude of that co-movement? And by doing that, I can see the impact of systematic information on the returns of any asset. Right? And so what that leads us to is this notion of a beta or a beta coefficient, right? And so I'm not going to need you to do any beta calculations, okay? It's actually quite simple to do. It's not hard to do, but really all I want to do is kind of have the intuition behind it. What does beta represent? Well, first and foremost, beta represents our measure of systematic risk, okay? So for any asset, we can measure beta. So I really should make this kind of beta I. So for any asset, you can calculate its beta, all right? And so the beta formally is a function of two pieces, okay? The first piece, rho, represents the correlation between your asset and the market, right? So all this is saying is kind of directionally, are you moving the same way as the market or not, right? So if you have a positive correlation, that means the market goes up, you go up. Market goes down, you go down, right? If it was a negative correlation, the market goes up, you go down, right? It's just directionally, are you moving the same way as the market? That's what the correlation coefficient is primarily capturing there. The second piece here is the ratio of your asset standard deviation to the standard deviation of the market. And what this is capturing is kind of like amplification, right? So the first piece says, okay, I got a positive correlation, I'm moving the same direction. The higher the second piece, the more amplified my response, right? So the market goes up a little bit. If this piece is kind of high, my standard deviation is higher than the market, well, I go up even more than the market, right? The market goes down, if this part's high, I go down even more than the market. So it kind of amplifies it, or it can kind of diminish it, right? It can mute the effect as well. If I have a really low standard deviation relative to the market goes up, I kind of go up, but not very much, right? The market goes way down, I kind of go down, but not too much. So this part says, am I moving the same way? And this says kind of to what degree, right? That's what's kind of driving this beta coefficient. That's what's inside, right? Again, in terms of measuring or actually estimating betas, it's very simple. We generally just kind of run some regressions, but we're not going to be doing that, so we don't need to worry about that. Again, I just want the intuition here, all right? So in terms of quantifying the numbers of this, right? Well, we have a benchmark, right? The way we start this out is by starting with, you can calculate the beta for any asset in any portfolio. So first thing you say is, what's the beta of the market? It's a portfolio, right? And so just look at these two pieces. Let's assume that the asset you're interested in is the market. So the first thing, the correlation says, what is the correlation between the returns of the market and the returns of the market? What is that? 1, right? Correlation of anything with itself is just 1. Perfect correlation, right? So if I was looking for the beta of the market, the correlation would be 1. And what's the ratio of the standard deviation of the market to the standard deviation of the market? 1, right? 1 times 1? Oh man, half the class is awake. 1 times 1, come on now. I'm doing softball now. All right, 1 times 1 is 1, right? So the beta of the market is 1, right? And that's our benchmark. That starts with our benchmark. So an asset that has a beta equal to 1, right? That means it has the same level of risk as the market, right? Beta of 1 means it has the same level of risk as kind of an average stock, all right? And that's kind of the reference point. If you have a beta less than 1, then you have less systematic risk in the market. You don't move very much. Market goes up, and you go up a little bit. Market goes down, you go down a little bit. But you aren't very responsive. Beta greater than 1, you're much more responsive, right? Market goes up, you go higher. Market goes down, you go lower, right? Much lower, lower than the market. So 1 is your average stock, less than 1, lower risk, greater than 1, greater risk. This is kind of really what I want you guys to take away from this, kind of the relative meaning of beta and kind of the intuition behind what's driving it.
I've seen that. You look up stocks, you see the beta.
Absolutely, yeah.
The bar.
That's exactly what they're talking about. Absolutely. Now the flavor, again, we're not getting into estimation here, but how this gets estimated, there are different models you can use to estimate it, so everyone kind of has their own flavor. So you might look at one website that says the beta is, A, and the next one says it's B. They should be close. If they're not close, they'll really go right. But they can be different just because of different flavors on how people estimate these.
This is assuming the stock is going in the same direction on the market.
It's assuming nothing. It's a numerical estimate, right? So
the market's going up 10%.
Yep.
Beta is 1. That stock's going to go 10%.
Yep. If it's 1, yep.
Now, if it's less than 1, it might go up 8%.
Sure, depending on
It's
the
greater,
magnitude.
if it goes up 20%, it's 1.7.
It could be higher, yes, so that's
The
right.
question is this, suppose it's going in a different direction than the market, the trend is stock.
If you have a negative beta,
Is there such a thing?
no. Not over the long term, right? You have short-term temporal times where it's based, again, with data, any screwy thing can happen with
Yes.
data, right? So if you pick certain periods, you can have periods where the market's going up and the stock's going down, right? Maybe there's great times right now, but the stock's like dying or something like that, that's fine, right? But if you look over long periods of time, we've found very little evidence of a negative beta asset, right? And we were talking to Marcus earlier, if you actually truly had a negative beta asset, what that would be like, it would be a hedge fee. It would be like insurance, right? Because when the market's going down, that means you have a stock or an asset that's paying you a lot of money, right? So the market's way down, this thing's way up, that's insurance, right? It's just paying you out. And at the end of the day, you'd actually not really need a return for that. You'd be willing to pay someone to own that stock because it's like paying a premium on insurance because it pays you out when you need it most. Yeah.
I'm thinking of the contrarian.
Right, yeah, so contrarian, so,
You're betting that the market's going to go the other way. So for example, what we're talking about here, that beer stock.
right,
When it's not that bad,
right,
good drink a lot.
right,
You know.
exactly, right, and so the reason that's not a negative beta situation is, if things get really bad, it gets really bad for everybody, right? So like if it's down a little bit, Coors might be doing all right and everything, but then when we start getting close to the Great Recession, Great Depression, everyone is going in the same way, right? So everyone starts going down the drain, right? So it's hard,
So it's
so,
always
yeah.
one thing.
So, yeah.
Could you define row with row?
Yeah.
That's the correlation between what again?
So the core, yes, that's a great question. So the row here, this is the correlation, if you imagine, I should write this. I should use some subscripts. So beta, this is for asset I. All right, so you're calculating the beta for some asset I. And so this is going to be the correlation between the return that asset I and the return to the market. And that's what row equals. The correlation between the return of asset I and the return to the market.
And how's that, is that a calculation or?
Sure, yeah, so typically people don't break this thing down. They just, estimate this model, right? So we just regress returns of firm I on the returns of the market, and then the slope coefficient that you get is your BI, right? And so that gives you this kind of composite of two effects built together, right? So this is the model that people typically estimate to get this, right? They don't break out these two pieces typically, but underlying it, if you write it out analytically, this is kind of what you get. And I think intuitively, it kind of tells you kind of what's going on. But when you actually calculate data, which again, you can ignore all of this. None of this will be any, you don't do this or anything, but this is what's going on. This is what you estimate right. Any other questions? So here's some just examples. I took these a little while ago, so they may have shifted a little bit, but these are some beta coefficients for some of the stocks we talked about today and some of the other companies of note. So you get kind of what you expect, right? So a company like Google or Apple has a beta greater than 1, so they're more, they sell gadgets and so forth, so they're more sensitive to kind of macroeconomic conditions, right? If things are going great, people are, have more disposable income, less money, they have less, so they're really kind of a function of that. You get things like Walmart and Campbell's Soup, they kind of do what they do, right? Things are going great, people shop at Walmart. Things aren't doing great, people shop at Walmart, right? It's different, but they just kind of keep telling along, same with Campbell's Soup. They kind of like just keep selling soup, right? And there's lots of fluctuations, but it doesn't change that much. And this is kind of like the death knell for like technology companies. Once your beta becomes like 1, you're not cool anymore, right? Because you make a ton of money, like except for when you have to write off 80% of Nokia's value that you just but you make a ton of cash still, but you just don't have a lot of growth, like excess growth, right? There's not a lot of kind of growth beyond what kind of the market. Microsoft grows as the economy grows, right? And it follows the economy falls. There's not a lot of innovation above and beyond that, so they just kind of move into the market. Right? Doesn't mean it's a bad place to work, doesn't mean it doesn't make money, but it's just not as cool as it used to be, right? So what I take from this is, at an intuitive level, beta kind of represents business risk, right? If you have if the risk of your business, fluctuates a lot with the macroeconomic, conditions, you sell gadgets, you're biotechnology or something like that, there's a lot of risk inherent in it, then you have a higher beta. If you kind of make a product that just sells, no matter what's going on, you sell soup, okay, you sell soup, right? And so there's ups and downs, but you sell soup. You have lower business risk, you have a lower beta, right? And what it also means is it's difficult to change, right? If a company actually is going to shift its beta, if there's like a systemic change, you kind of have to change who you are, like Apple. Right? When it was Apple computers, they had a lower beta. They had a beta like a computer company. But when they dropped the computers and just became a gadget company, innovation, whatever else, their beta went up, right? Because they became a different type of company, right? So that's the same type of thing here. Or you could think of a conglomerate that has a lot of different businesses. Well, it's a composite of, its beta is a composite of all the betas of all its businesses, right, put together, depending on how important they are for the business as well. So beta to me, again, it's a measure of systematic risk, systematic risk, but really, again, at its heart, it's measuring kind of the riskiness of the underlying business of the company. You can find beta anywhere, right? Any place. Okay, little concept check question here. Let's consider you have the two stocks, security C, security K. We're told their standard deviations, 20 and 30. We're told their beta is 1.25 and 0.95. First question, which security has more what we call total risk? C or K?
K.
Why?
Higher standard deviation.
Yep, standard deviations are a measure of total risk, right? So K has higher standard deviation, so K has higher total risk. Which security has more systematic risk? Right? Betas are a measure of systematic risk, so C has a higher beta, more systematic risk. Last one. If you were to buy these two securities, or you're thinking about buying them, which security would have a higher expected return?
K.
I hear C and I hear K. What's your arguments in favor of both?
K. Higher standard deviation, higher risk.
Okay.
Higher potential for return.
Okay. C? Who's going to argue for C? Because of high beta. I'm actually going to go with C, based on the systematic risk principle. Right? We said the systematic risk principle says that an asset's expected return is a function of its systematic risk. Right? Because again, it is true that K has higher total risk, but what happens is when you take K and drop it into a well-diversified portfolio, all that extra firm-specific risk melts away. Right? And so when we're thinking about pricing these assets, and again, for society, you can hold as much K as you want, but that's kind of on you. You're not getting anything extra for that. The only thing that society is paying for is the systematic risk we can't get rid of. Right? So all that unsystematic risk, you can hold a well-diversified portfolio that eliminates any of that extra kind of firm-specific risk. Right? And that's what is embodied in the standard deviation. It's just saying, yeah, K does have more total risk, right? But once you put K in a portfolio, well, the only thing that's going to matter is how much systematic risk it has. And its systematic risk is only 0.95. Whereas on the C side of things, its systematic risk, it's higher than the market. And there's nothing you can do about that. You can't diversify that away, right? And so we're stuck with systematic risk. So again, according to the systematic risk principle, right, which says the only thing that matters is the systematic risk because we can diversify away all the unsystematic risk. Right? And so again, it goes back to that principle. Society gets nothing from you putting all of your money in a single basket, right? It gets nothing from you putting all of your money in K. Anything above and beyond people mixing their money up, right, and then funding all of the projects, right? The only thing that matters is the systematic risk.
So the beta is the systematic risk?
Betas are measured.
Deviation is total risk?
Yep. Is that correct? Standard deviation are a measure of total risk. Betas are a measure of systematic risk. Now, I'm not going to ask you to calculate betas. Oh, sorry.
One
No.
question.
No.
You said, you started to say something, you chose the expected return as a function of the
Systematic risk.
systematic.
Yeah, that's what we call the systematic risk principle.
Then why
Why is that?
Why would you pick beta?
Because it has a higher beta. Because we're saying, so beta represents systematic risk, right? And according to the systematic risk principle, expected return is a function of systematic risk, right? So if we come back, there we go, this right here. Because we just asked, the question was which one has a higher expected return? And so the expected return depends only on systematic risk.
So the higher that number is.
The higher, right? And that's this chart.
The expected return.
Right, that's this chart here, right? The higher the risk, the higher the expected return, right? And because beta measures systematic risk, the higher the beta, the higher the expected return. Other questions? All right, so in terms of, I'm not going to ask you to calculate betas of the individual assets, but I will ask you to calculate betas on portfolios, okay? And so we should talk about how to do that, right? It's actually fairly straightforward. The beta of a portfolio is simply the weighted average of the betas of the assets in the portfolio. Okay? So if I have, again, I know how many assets are in my portfolio, I know each of their betas, I want to know the beta of the whole portfolio, I simply take a weighted average. Right? So we go back to our $10,000 portfolio of Google and Coors. I want to know that beta, the portfolio of that beta, the beta of that portfolio, right? I'm going to take how much my money is in Google times Google's beta, plus how much my money is in Coors times Coors beta, right? It's simply just a weighted average. So in this case, 40% was in Google. If you go back a couple slides, you saw that Google's beta was 1112. You don't have to know that, I will tell you that. Plus 60% of my money is in Coors, and Coors beta is 0.79. I take that all together, you get 0.9. Questions? I have a question. When we looked at the standard deviation, as we've just been talking about, these two different measures of risk. Standard deviation and beta, right? And what I just set out here is this. Right? The beta of my portfolio is a weighted average. Right? M different assets, each one's weight times beta, add them together. And so that's how we calculate it. I said you can't do that. Right? We saw earlier you couldn't do this, but you can't do this. Why?
That specific stock, right?
So is this, right? So this is standard deviation of so that's each of them have their own standard deviations.
But the beta is comparing to the total market,
Okay.
so it's kind of totaling against
Okay.
the other way. It's not, it's just individual stocks, but then they're trying to, because you got a diversification
Yep.
in the beta, which you don't have in the individual stocks.
I think that's pretty close. So we said, let's just rephrase it a little bit, but I think we're right there. We said up here why we couldn't do this was the magic of diversification, right? We said we couldn't take a weighted average because it ignores diversification. The fact that when you mix up these assets, a lot of that risk goes away, right? So if you just took a weighted average, you'd be ignoring diversification, right? Well, when we come down here, when we're left with systematic risk, what's the impact of diversification on systematic risk? Is systematic, if you mix up a bunch of assets, right, does it lower the level of systematic risk that you have? No, there's no impact, right? So because mixing things up doesn't impact the level of systematic risk, we're not ignoring anything. Diversification has no impact on systematic risk. So we simply can take a weighted average because these betas are not impacted by diversification, right? Your total risk is, your systematic risk is not. Right? So because systematic risk is not impacted by diversification, the beta of our portfolio is simply a weighted average.